Dear viewers, welcome to this episode of Expert Speaks. There are legendary investors who have built colossal amount of wealth using the principles of value investing. Value investing is a proven technique in the way to building the wealth, but very few people practice the real essence of value investing. In my today's episode, I'm going to talk to one of the fund managers, Mr. Daylynn Pinto, the senior fund manager at Bandhan AMC, to take you through what is value investing, why it makes absolute sense for you to follow the principles of value investing, and how you can effortlessly build wealth if you practice value investing to the core. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
To talk about the value investing, who could be better than the experienced fund manager, Mr. Daylynn Pinto? Mr. Daylynn Pinto is a senior fund manager at Bandhan AMC, which is earlier known as an IDFC mutual fund. Mr. Daylynn Pinto has more than 15 years of experience in the equity management. He started his career with UTI Asset Management Company. Later on, he built his career through Bandhan AMC. Let's listen to Mr. Daylynn Pinto, what he has to offer for us today. Welcome to this podcast, Fund Manager Daylynn Pinto. I'm really excited to talk to you. I have heard you multiple number of times. And who can be better to talk to my audience on value investing than yourself? Welcome all to this episode.
Thank you. Thank you, Mr. Bhatt, for having me. It's a pleasure to be here.
Mr. Daylynn Pinto, there are so many forms of investing. Each one has his own style. There is a Tendulkar, and there is a Kohli, there is a Sunil Gavaskar, and there is a Vivian Richards. Value investing of all of that looks very interesting. It's an educative series. I just thought I'll ask you a few questions so that my audience get educated on this field of value investing. My first question to you is, what is value investing and how it differs from other forms of investing?
So that's a very interesting question, and it's very commonly asked, I think, to a lot of people, a lot of professionals in the industry. I think the simple notion that most people have about value investing is buying something cheap. Typically, when you hear the word value, it means buy something cheap, buy something at a discount. And in equity market investing, that typically means buying something at a low P or a low price to book or some sort of low, ratio as such. Right? Unfortunately, that is not value investing, and that is not the way one should actually think about value investing. There are a variety of businesses that are available for equity investors to look at, and every business has its own cycle. Every business has its own sets of qualities, has its own sets of characteristics, and therefore would have its own valuation parameters that are required to correctly assess whether that investment is a good one or a bad. So something just being cheap does not necessarily mean or equate to value investing. At the same time, I think a lot of people also believe that buying a particular business or a good business or a great business at any price, is the right thing to do because it's such a great business. So why not pay off, right? And to our mind, that is also something that doesn't make money over the long period of time, because the kind of assumptions that you're actually going into can turn out to be far different from what you initially thought. So to our mind, very simplistically put, buying a great business at an average price or buying a business that is not great, but a very attractive price are one and the same thing. And that is really the hallmark of value investing, right? We don't close our minds to any type of sector. We don't close our mind to any type of company because we believe that at a particular price, anything can be exciting from an investment perspective. And it is more important for us to really focus on the business cycle, on the company's fundamentals, the company's cash flows, the company's earnings potential when we are deciding what price to pay for a company, right? So I think value investing is being patient, being contrarian with your money and hoping that over a 3 to 5 year period, what the market currently doesn't see or doesn't foresee comes to fruition. And that's really what generates the alpha that we are all looking for.
Very interesting. So one thing I took from this is something which is cheap is not value. At the end of the day, there should be great businesses. It's an attractive price point at which you enter could be the value investing. This is the message I picked up. Now, who made these value investing popular, or are there prominent investors who have hit success or have become very popular because of their success in the value investing mode?
So, of course, globally, there are a lot of names out there. It started with Benjamin Graham, of course, the father of value investing. You have Seth Klarman, you have Warren Buffett, Charlie Munger, you have Bill Miller, you have Howard Marks. So I think there are plenty of value investors. But one very amusing thing that I find is that when you Google the best value investors in the world, you'll realize most of them are fairly elderly gentlemen. So guys who are, at least 60 plus, right? And these are guys who have seen a tremendous amount of market cycles across the world. And I'm sure a lot of their gray hair really comes from the fact that they've debated growth and value and momentum and all kinds of investing styles, over the last 3, 4, 5 decades of their investing career. And yet they stand by value, right? And therefore, there's obviously something that they've seen and they know and has worked for a very, very long period of time, right? So I think more than trying to really define growth and value as we often get into debates, I think the real key is like I said, finding a business that you like, that you think can grow, that can do well, but more importantly, buying that business at the right price. So we've coined a term where I call my style of investing BARP investing, which is buy at the right price, right? So whatever business you evaluate, it is important to buy it at the right price because that's when you make an above average return.
Very interesting. It takes me to my favorite game of cricket, You say that value investing is most of the people with gray hair and on the other side of the life cycle. It's just like some cricketer who enters the cricket, the youngster, the fast bowler or a new batsman. Young bowlers try to bowl fast and the new batsmen try to hit 6 out of every ball. Whereas a seasoned player depends on bowling that length and the movement of the ball, and the batsman waits for the ball and tries to hit 6 out of the loose ball. Probably this is similar in our investing career. Probably.
Yeah, that's absolutely right. I think you've hit the nail on the head. That I think as people or as investors mature, and some of these renowned gentlemen's names that we've taken on the show, they play every ball at their merit, and that's what all the great batsmen have done. And all the great bowlers bowl depending on the conditions that the pitch offers them, right? And I think it's not just about pace. So they know when to slow down, they know when to speed up, they know when to bowl a bouncer, they know when to bowl a yorker, right? So I think value investing just about that, is trying to find that when a business is overvalued, when the assumptions are sky high, and when the risk reward is not favorable, you try and avoid those sectors or stocks. And value investing is about rotating or buying into sectors and stocks where you believe the price offers you a favorable risk reward. So I think that's as simplistically as we could potentially put it.
See, one question that comes to my mind when you speak about value. Value is not something which I personally feel is there every time. Markets will go from a bull phase to a bear phase to stagnant phase, crashing down. Is value investing is an evergreen philosophy? Is there value which is visible at every point of time, or value investing has cyclical tendencies? If an investor wants to accept value investing and move ahead, how do you see as a fund manager the value investing? Cyclical or evergreen, or anytime anyone can come and embrace value investing?
I think this is a very interesting question, and in the context of the Indian market, I think it's very important. If we just think about what happened in 2018-19, so it's not so long ago, a lot of investors who perpetrated the growth style of investing, did extremely well in the market. And not only was growth doing very well, both globally and in India, but at the same time, large caps were doing much, much better than mid and small caps in 2018-19. And we kept hearing things like the big get bigger and the big get better. And, market share gain is forever going to be there, etc. These were the kind of arguments that were thrown at everyone at that point of time. 3 years later, we're in a completely different market where mid and small caps from those depressed levels have completely generated, almost all the alpha that's out there, where the traditional growth-oriented stocks have underperformed substantially. And what we typically call value-oriented stocks have done very, very well in the last 3-4 years. So I think from an evergreen perspective, zoning out and looking at the market based on what macro cycles are actually prevalent at that point of time is probably more important, right? And I think when you look at the last 2 decades, I think we've all seen sectors perform well for a period of 4 to 5 years and then have their share of underperformance. And rotating from sector to sector or in and out of a sector is typically what value investing is trying to do. So if you remember, when we had the mother of all bull runs between 2004 and 2008, infra was the momentum sector. Infrastructure was the growth sector. Everybody thought it was only going to be infra forever, right? And sectors like FMCG did very, very badly at that point of time. Once the infra bubble kind of burst in 2009-10, if you look at the best performing sectors for the next 4 to 5 years or the next decade as such, FMCG took the lead. And if you typically dial back 10 years ago and look at multiples that FMCG as a sector were trading at, you'd have been scratching your head and said, hey, why was I not buying FMCG at that point of time? It was a great value investment, right? Now, typically, people don't associate a sector like FMCG with value investing. But when you actually go back and look at what valuations FMCG companies were trading at relative to infrastructure companies, relative to power sector companies, etc., you'd have suddenly said, hey, these companies are cheaper given that they're consumer-facing businesses, they generate a lot of free cash flow, they have very good ROE, ROCs, and they're trading at multiples similar to some of these companies. So, to my mind, it would have been a no-brainer had we had the same wisdom back in 2010, right? If you roll forward to today, 3 years ago, mid and small caps as a basket, PSU companies as a basket were deeply, deeply, deeply undervalued, right? And anyone who even took a small position in any of these, sectors, whether it was a mid or small cap allocation or whether it was a PSU sector allocation, has been very, very, very handsomely rewarded as compared to, let's say, owning private banks or owning FMCG for that matter, which to my mind in 2018-19 were grossly overvalued, right? So the same sector, you see, which was probably a value sector in 2010, became an overvalued sector in 2018-2019. Right. So value investing is really contextual. It's about how you read market cycles, how you read market macros, and how you're able to rotate. So to my mind, it's an evergreen philosophy. It is not a philosophy that works 1 year and doesn't work another year. All fund managers go through that, painful period of transition, but it is definitely a strategy that works, across the test of time. And like we go back to our wizards of value investing point, if people have been doing it for 40 and 50 years, and these are the same people's books that we read, there has to be some merit to it.
Very interesting. And when you were speaking, I was just going behind my memory lane. I was a stockbroker for a while. And I remember in Bangalore, where I was a sub-broker with Angel Broking at the time, I remember a news comes wherein which one of the top FMCG companies, its share has come down. The total market share has come down. The size of the pie has increased. The percentage share of market, what it was commanding, fell down. And the stock badly retraced back. Everybody thought that as if this company is closing down. Nobody read this correctly. What I observed was that this stock moved up to a dividend level of 5% on the stock. And the banks were giving about 5.5% on the FDs, whereas this stock, which is totally debt-free, 70 to 80% of its cash flows will go out in the form of dividend. I simply said, let's latch on to it. Even in the recent past, I saw in many of the utility companies, you see the kind of the dividend yields which were there. These are all debt-free companies, or these are government companies. These are very, very essential industries. They can hardly backfire. So you need to be having a courage and latch on to that. And if I look at my own life, I would say for certainty, whenever I've taken such calls, these have turned out to be extremely rewarding. Again, going back to the 2008 period, look at what happened in the banking at that point of time. Nobody wanted. The bank FD rate was 5.5%, whereas every bank, irrespective of whether it's a PSU, whether it's a regional bank, whether it is a private bank, was quoting a dividend yield of anywhere from 9 to 12% in 2008. So it needed nothing except the courage and the money to latch on to it. So somebody at some point of time said that the key to making money in the market is that conviction combined with courage and cash. 3 C's. You should have a conviction. You should have a courage because your environment around you is so negative And you should be ready with the cash. If you're already invested everything and you're pumped everything and you're empty-handed, there's nothing one can really do about. So value investing is very rewarding in my personal opinion, which is what you echoed here. And I definitely second your thoughts on that. One of the doubts which is perennially there in my mind is I have heard about a word called value trap. Somebody gets into a stock or a sector and it shows the signs of a value. What is the value trap is actually about? Is that something one has to be careful about?
Yeah, I think that's probably the biggest pitfall of value investing is that typically value traps occur when we start to try and hunt for a golden opportunity in a market where there isn't much value offering actually, which means that you're probably better off sitting in cash or deploying your money in fixed income rather than trying to hunt for the next multi-bagger somewhere far down the line, right? It's a typical mistake that you make mostly in bull markets. And just to give you a very simple example, let's take a sector and we look at, let's say, today's best FMCG companies. Today's, some of India's top FMCG companies are probably trading somewhere between 45 to 55 times, right? And then we suddenly do a screening analysis and we realize, hey, I found an FMCG company that's trading at 20p. So let me buy that because that will become 45p and that's how I'll make money, right? But it goes back to my first point about value investing. Something that is cheap is not necessarily value. There is a reason why that company is trading at 20 times. It's more important to understand why it is trading and can it break out of that multiple and what is required for that business to break out of that multiple. That company might be operating in a certain product category wherein profitability just can never improve. It is highly competitive, or it's a very regional oriented company, doesn't have a pan-India presence, or it's a semi-commoditized industry, it's not really a branded industry. So there could be many reasons, but just blindly thinking that, oh, here's an FMCG company which is at 20p and some of India's big boys are at 45 times. Let me buy that. That's a value investment. These are the kind of value traps typically that most investors fall into, right? The second value trap that typically, at least in the Indian context, we see very commonly is holding companies. There's always this, dream that holding company discounts will go down to zero. But, there is no real science to it because unless there is a proper corporate action that's taken, typically holding company discounts, narrow a little bit in a bull market and then widen in a bear market. And again, a classic example of value trap without trying to figure out what is the underlying cash flows that some of these holding companies actually have, right? Rather than you just buying a derivative of an underlying stock investment that these holding companies have. What is in it for you as an investor? Like you rightly or aptly put, when you thought about this FMCG investment of yours or you thought of buying some of the utilities, you rightly mentioned a dividend yield number that made it attractive for you to give you that courage to deploy them. So I think that is also something that is very relevant, that some of these companies, to avoid value traps, have to give you some sort of comfort to take that courage. Blindly being courageous need not necessarily result in great outcomes. And I think those are the type of value traps that we must try and avoid, to the best of our abilities.
Daylynn, value investing looks encouraging. And when we discussed on the value trap, there are some pitfalls somewhere. So if somebody wants to go ahead in the value investing more, what are the key risks an investor has to keep in mind? It's good to know, are there any negatives in value investing?
No, of course. I think, there are risks to all forms of investing and value investing is no different. Clearly, I think one big risk is to try and avoid value traps. We just discussed it. I think that is typically the biggest risk we take. The second is one needs to, have patience when they think about value investing because typically value investing involves buying companies that are not the talk of the town at this point of time, right? That is why you get them at an attractive price. And that is something that you would have to nurture as an investment and hold, and don't lose patience because people typically lose patience. So loss of patience or lack of patience is a risk to a value investor. It will never help you make, money over the longer period of time. And the third and most important, as we discussed right at the start of the show, is don't fall for buying anything that is cheap as the definition of value investing. So I think avoiding value traps, having the right amount of patience, and not buying things just because they're cheap. I think these are the three most important risks that one must try to keep in mind if they are to become successful value investors.
If somebody wants to do a value investing, he's attracted, he feels it's safe, it rewards me over a period of time. the mutual fund industry, has it category meant for value investing? Are there specific funds which help an investor to invest through the principle of value investing?
Yes. So SEBI has come up with a scheme categorization, and within that categorization, there is a specific category dedicated to value investing. So it's really called the value category. So there are multiple funds that are eligible for investment under the value category. From our company's perspective, Bandhan Sterling Value Fund is the fund that comes under the value category. So investors are free to choose, within this category. But my sense is that investors, one is to look at the category. And the second is, I think it is very important also to know your manager, because different managers have different definitions of how they perceive all kinds of investing, whether it is growth or value. So even if you look at a typical growth category, you should know your manager, and you should develop some sort of comfort with what is the kind of style, what is the kind of horizon that manager typically looks at when he builds a portfolio. What are the kind of guardrails the manager is putting, on the portfolio? Does he take very aggressive calls? Does he take very concentrated positions? Is his active share very high? Is he very far away from the benchmark, etc.? So I think that is a little bit of homework that all investors must do, to help make a better decision. But simplistically put, SEBI has a clear category for value funds, and Bandhan Sterling Value Fund is our fund that is present in that category.
Let's say some investors want to go towards value investing. Do you advise for him any exposure control to this sector, or because it's very attractive, the investors say, I have abundant patience, so I'll put 100% of my money into a value fund? Do you advise any exposure control caution to the individual investors?
So typically, I think every investor has to look at two or three things from their perspective. One is, what is their risk appetite? The second, what is their current asset allocation? And how it's shaping up, right? So I think these are two things that are individual, and every investor must look at that before they decide to make any investment decision, right? Typically, as a portfolio manager, we never put all our eggs in one basket. That is why we buy a number of companies in our portfolio. We don't bet on one or two or three or five companies. And therefore, as an investor, I would think who looks at mutual funds, you typically don't want to bet all your money in a particular fund, right? So I think the simple answer is yes, have a variety of funds in your portfolio. Don't bet all your money on a single fund or a single strategy. I think that would be my advice. But again, it depends on the individual. The second is that I think as we all mature, as investors mature, as managers mature, and if you do believe that a value is not a thematic kind of strategy, but more an evergreen type of strategy, which we've already talked about in detail, I think there is no harm in having larger allocations to value as compared to what we have seen in the past. So I think as this category continues to show, alpha generating opportunities, I think investors automatically will start to give a higher weightage in their overall investment basket to value as an investing style. So that is really how I would approach it.
I will ask you a hypothetical question now. The question is that value funds, if somebody has, let's say that there is a raging bull market, and the investors latch on to the value funds. When the markets give up and headed towards a correction, crash, whatever it is, are the value funds, do they have a tendency to have lesser drawdowns compared to the rest of the funds?
So I think typically if we look at the past, there are two problems with answering the question. One is that the categorization of value funds has started only in 2018. And therefore, I think the category does not have a long enough history for us to come to a very conclusive answer on this particular question. The second is that, again, it depends on the value fund that you are particularly investing in and how the manager is constructing the portfolio, right? Let's look at a hypothetical situation where, as a manager today, since there has been quite a lot of underperformance in private banks, since there has been quite a lot of underperformance in FMCG, since there's been quite a lot of underperformance in IT, for example, in the last 3 or 4 years, if a fund manager believes that on a certain set of measures, these sectors are starting to look attractive or are appearing value-like basis our prior discussions that we've had, and have a larger tilt of the portfolio to some of these sectors, and the market were to go through a crash, would that particular fund fall as much? Maybe not, right? Because these sectors are typically, or these kind of companies are typically known to be defensive, as we call it in some sense, especially when there's a market crash. But if we are talking about a fund that has, bet the house on some of the sectors that are currently in flavor, right? Whether it's the overall PSU pack only, or if it's the overall capex cycle, or power, or real estate, or chemicals, or whatever, right? Like, there could be a whole host of sectors. I don't want to single out anything. There could be a larger probability that some of the near-term momentum sectors could potentially correct more, right? But ultimately, very difficult to say, because ultimately money is made in sectors where earnings growth outlook is typically the best, right? And as long as there is no change in that direction, there should potentially be no differential in the way the portfolio or the underlying portfolio performs. So tough to answer the question on a 1:1 basis. I think there'll be a variety of outcomes, but I do believe that the outcomes that we saw in 2018-19 versus hopefully what outcome we will see in future might not be as stark. And I think that will give more and more confidence to investors that whether you look at growth or value, it really depends on how the manager is navigating the portfolio to a great extent.
Different investors have different traits, personality traits, risk profiling, age, experience, and kind of a thing. In your opinion, which type of investors are most suitable to accept and practice value investing? What kind of a traits an individual investors must exhibit if he has to derive benefits out of this value investing?
So I think the first is not to get carried away with market movements. One needs to have a rational approach when you think about investing in sectors and companies. The second is to have lots and lots of patience. I think it is very important if you really want to make big money, not to have a short-term trading sort of mentality. So patience is something that's very important. The third is to be contrarian, to think out of the box and not to go with the flow, as we call it. I think a combination of all these three traits are very, very critical. So having conviction, being rational, which typically means having some sort of conviction to hold on to what you think is the right thing to do. The second is to have patience to let that conviction play out. And the third is to be contrarian, to start to question everything that you hear and see. I think these are the three very, very important traits for value investing.
Thank you, Daylynn. I enjoyed talking to you. It's a great amount of knowledge, great amount of insights from managing funds, selecting of stocks that you guys do. And there is so much of a thing for an individual investors to take from this conversation. I remain in gratitude to you for your kindness to spare the time and share your experience, knowledge for the benefit of my audience. Thank you very much, sir.
Thank you. My pleasure. My pleasure. Thank you.
Dear viewers, hope the conversation I had with Daylynn Pinto gave you the ideas about value investing, a proven method of wealth creation. If it helped you to understand this field much better, do not forget to give me a thumbs up. If you are a person who is watching my channel for the first time, or if you are yet to hit that subscribe button, please press the subscribe button right now. Do not forget to press the bell icon as well. I give you 2 videos every week, Tuesday and Friday, 4 p.m. IST. Do not miss one single video. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you next Tuesday, 4 p.m. IST, with yet another expert, with yet another useful topic. Till then, stay safe. Jai Hind, Jai Bharat.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Press the bell icon for more details and subscribe our channel.